Hi, I'm Seth Freudberg. I'm the Director of Options Trading here at SMBU in Manhattan. I'm also the head trader of SMB Capital's Options Trading Desk. So today was a big day. The Dow finally closed over 20,000. And along with that came a pretty large drop in options volatility. In fact, the VIX closed today at 10.59 or traded today around 10.59. Which is the lowest I've personally ever seen it. I'm sure others have seen some lower numbers. It's the lowest I've ever seen. And so along with reduced options volatility comes a reality for market neutral options traders, and that is that the trade's risk rewards change in very, very low volatility times, and they change usually in an adverse way for the trader. And essentially, the risk reward of the trades changes in a negative way for the trader, and it can be fairly dramatic. Let me give you a good example. Let's take a trade in which you're going to be putting on an iron condor for the March monthly expiration in 2016, which was last year, just around this time. And if you were to do that, you would find that you would receive a pretty healthy credit. The condor is 400 points apart, and you'd receive a very healthy credit for doing so. You take that same iron condor and using a criterion of the shorts being under 10 deltas on both the call and the put side, you would get a much smaller width in your iron condor, and you would get a significantly lower credit as well. Let's take a look at the specific statistics on this trade. The March 2016 trade is 400 points wide. The credit was 46.25, which would provide you with a return of 18% if the trade expired and the market was between the short call and the short put. On the other hand, if you were to do that same under 10 delta trade on the SPX today, you would have found your iron condor would have been half as wide, 210 points wide. Your credit would be $3,935, and your return on the trade if held to expiration would be 15%. That's a big drop in credit. That's a gigantic drop in the width of the iron condor. Both of those factors are adverse to the trader. So what's the point here? And the point is that the best traders I know have standards for their trades. They don't just put on any trade. They have risk-reward trade-off requirements for the trade. So, for example, if you had an iron condor trader and he said, I simply will not do a trade where the return is less than 16%, well then, you couldn't put the trade on today. He presumably back-tested it, has worked experientially with iron condors for years, and knows that in the long run, if you put on a trade with less than 16% return potential, it's just not going to work out well in the long term. They design their strategies and they backtest their strategies based on these common sense requirements, and experienced traders are disciplined, they have standards, and they maintain their standards. So if the market doesn't provide you with the risk-reward trade-off that your strategy demands, it's imperative that you don't take that trade. Now, for day traders or swing traders, that's sort of an easy statement to make. Don't take the trade. You look at your 300 other charts you're looking at and you find another trade to take. Whereas for a market neutral options trader that is keeping his capital in the market at about the same level month after month after month, skipping a month is a bigger deal. Some people struggle with the idea of skipping a month, but they struggle because there's a fallacy in their mind, and the fallacy is that this is options income trading. That term, which I've spoken about before, is something that I have a problem with, implies that you'll make income every month from your trades. Well, that's not true. You're going to lose certain months. So it isn't really options income trading, is it? It's really return trading. You're looking for a certain return a year. That return, that target return, may be something you use to pay your bills. It may be something you simply use as a measurement of how you are growing your investment portfolio. There could be a lot of things that you could be striving towards, but one thing is for certain: you're going to have winning months and you're going to have losing months. Skipping a month with a bad risk-reward trade-off is not only not a bad thing, it's a good thing. Because if you have proven to yourself through live trading and through backtesting that in the long run, taking trades with poor risk-reward trade-offs will not benefit you, it will ultimately reduce your return, then why not skip that month? The reason you may not want to skip a month is because you feel like, well, I've got to have my capital in the market every month regardless, otherwise I won't make my, quote, options income. Well, that's the problem with using the term options income. You think of it as something that will pay your bills every month, but that's obviously not true because you're going to have losing months. So if your return at the end of the year is better by skipping months with poor risk-reward trade-offs, then shouldn't you skip those months? It seems like the answer's pretty obvious. So what's the moral of the story? Well-designed trading plans have strong minimum pricing standards, and competent traders don't violate those standards. If it doesn't meet your trading criteria, you can't trade it. You should not trade it. And in fact, your return almost definitely will improve if you do not trade it. In other words, keeping your capital out of the market in areas, in periods of the market where the risk-reward trade-off is poor, is a good idea, and you will make money long-term. You will make more money long-term that way than you will by just repeatedly putting your capital into circumstances which are not favorable to your trade. There's nothing wrong and everything right about skipping trades where the risk-reward trade-off doesn't work. Keep that in mind, and your returns long-term will undoubtedly improve. Thanks very much, and we'll see you next week.